What is going on, investors, and welcome back to Tipranks TV, the home of exclusive Tipranks content that you can watch in an ad-free way. And today you're joining us for another episode of Analyzing for Alpha, the no hype series that delves deep into the fundamentals of a business to understand whether it's not only possible, but actually probable that the stock will outperform the markets in the long term. So let's dive right into it. Today we're looking deeper into Amazon, pretty much one of the best stocks to have ever existed after returning an incredible 170,000% since its IPO 25 years ago. Today, the picture looks a little bit different though, as the stock has been leaving many retail investors increasingly frustrated over the last 18 months because it has done absolutely nothing at all. Back in September 2020, the stock was sitting at just under $3,000, and today, in March of 2022, the stock is sitting at just under $3,000. Now, of course, Amazon doesn't pay a dividend, so anyone that's been invested in this stock over that time period has suffered a huge amount of opportunity cost, and now frustrated holders are screaming that the stock has reached its limit and there's not much growth left in the business or the stock. And that, my friends, is where I would tell people to pause for thought, because occasionally we see a massive disconnect between a stock and the underlying business. And whilst the stock, as we said, has not done anything over the last 18 months, the business certainly has. The problem, however, which in actuality isn't a problem at all, is that the decisions that the business has been making over the last 18 months to invest significantly in the business have not yet shown up in its financials. But when they do show up, I have a high degree of confidence that the stock will not be sitting at $2,900 a share, and the top analysts agree with me. But we'll get onto that along with my personal valuation shortly. Now, Amazon's financials are absolutely, without a doubt, unequivocally deceiving. And that's why you have to dig deeper into the business to really understand the numbers. The first and most obvious way in which Amazon's financials are deceiving is the net profit figure from their most recent quarterly results. They posted a net profit of $14 million for the quarter, representing 100% year-on-year growth and absolutely blowing analyst estimates out of the water. Except the true underlying profit actually fell by about 50%. So you're probably thinking, Hakeem, what are you talking about? That doesn't even make sense. But the reason for that is because Amazon posted an $11.8 billion pre-tax valuation gain on their investment in Rivian. Now, as far as I'm concerned, this isn't really a profit at all. They haven't sold their stake in Rivian, there's no cash inflow, and the gain was never realized. In fact, fast forward to today, and Rivian has lost 54% of its value since the last quarter. So in the next quarter, Amazon are then going to post a multi-billion-dollar loss, which again has absolutely no bearing on the underlying fundamentals of the business. What I'm trying to demonstrate here is that there's a lot of noise within Amazon's financials that you really do have to weave through. But that kind of noise actually presents opportunity to those that are willing to put in the work to understand it. I've made a comparison between Amazon's financials and the other big tech stocks, and on the face of things, Amazon looks like the worst out of the bunch. Except for revenue growth, where they come second, Amazon appears to have the worst EBITDA margins at just 13%, the lowest free cash flow margins at just 4%, and despite all of that, they trade at the fourth richest valuation from an enterprise value to next 12 months EBITDA multiple. So what gives? Well, free cash flow margins are so low for Amazon because they place more emphasis on reinvesting in the business through capital expenditures, and the higher the capex, the lower the free cash flow. This table here shows the capital expenditures as a percentage of cash from operations, and Amazon reinvest about 50% of all of the cash that they generate. Compare this with the other big players that on average only reinvest about 27% of the cash from operations, and you can suddenly understand why free cash flow margins for Amazon are so low. Now, this stark difference in reinvestment is illustrated perfectly by this graph, where Amazon have decided to further capitalize on the benefit that they received due to COVID by ramping up their capex, compared with the other tech stocks where reinvestment has plateaued. Spending $45 billion in a single year on capex to build out their infrastructure and completely crush any competition is only going to further solidify their market leading position, which will present itself as higher growth and higher margins later down the line, whilst in the short term providing an unfair reflection of the true normalized free cash flow margins of the business. You probably won't be surprised to hear that the story is much the same for reinvestment in the business through research and development, where Amazon on average reinvest 31% of their gross profits into developing new ideas and products to reap the benefits later down the line. Compare this with the other big tech companies who on average reinvest 22% of their gross profits into R&D, and you begin to understand why those EBITDA margins that we were looking at earlier appear to be so low for Amazon. The truth is that at any point, Amazon could decide to reduce their reinvestment into the business at the click of a finger and instantly make the business more profitable. However, the Amazon mindset of continuously pumping money back into the business is what has led them to that 170,000% growth since their IPO, and I suspect it will continue to serve them well in the future. At least that's what my valuation model tells me anyway. Now, as always, I've been conservative within my model. I really don't like unnecessary risk, so I make sure that the actions I take when building out my valuation mitigate against just that. So remember, despite the heavy investments that the business has been making, we're talking 1 to 5 year revenue growth of just 15%, followed by revenue growth of just 9% in years 6 to 10. I'm expecting gross margins to remain completely flat at just 42% in line with the most recent year, and for operating margins to gradually increase by about 1% per year from 5% up to 13% as it scales back that significant R&D over time. By 2031, we could be looking at total revenues of $1.4 trillion with a net profit of $166 billion. Notice how that's a net profit margin of only 11%. Again, a conservative estimate given Amazon's divergence into higher margin verticals such as AWS. Now for the DCF, EBITDA margins increase from 13% to 21% and unlevered free cash flow conversion increases from 40% to 65% as capex as a percentage of total revenue is reduced over time. With a weighted average cost of capital of 9.2%, we could be looking at an intrinsic value per share, according to the DCF, of $3,700. Now, if we compare that to the multiple of earnings model, which takes that $160 billion of profit in 2031 and applies a PE multiple of just 20, which by the way is significantly lower than the current multiple of about 60 once you remove the Rivian gain, we're looking at an intrinsic value today of around $3,100. Taking the average of the two, we could be looking at a fair value of almost $3,400, offering a margin of safety of 16% at the current price. So I'm sure you'd agree that it's all starting to line up quite nicely for Amazon, but things get even better when we move across to Tipranks. Amazon has a smart score of 10, indicating a strong possibility of outperformance. Analysts tend to agree, with all 30 of the top analysts providing a consensus price target of $4,200, suggesting a 45% upside over the next 12 months. Now, I think I can be fairly confident in saying that 45% over the next 12 months will almost certainly outperform the S&P 500. It should then come as no surprise that hedge funds are loading the boat with this stock, with world-renowned hedge fund Edgerton Capital adding almost $1 billion of stock to their portfolio. It's also worth knowing that Edgerton Capital have returned 193% since 2013, compared with just 53% for the average hedge fund, so they're definitely worth paying attention to. It's not just a select few people that think this though, as Tipranks shows us that 6.5% of all the top investors, covering 114,000 portfolios, hold Amazon within them, with a huge average allocation of almost 14%. So my question to you, is it just a matter of time before we start to see Amazon take off once again? Let us know in the comments below, and as always, from everyone here at Tipranks TV, thank you.